Okay, they're jumping on quick. Hey everyone, welcome.
Hi.
So you should be able to see that participants thing now. You can see all the names coming in. 48 already. Wow, it's going up very rapidly.
What was the final registration number?
Didn't look actually this morning, but I think we're well over 100.
Yeah. So you just let me know when's the right time.
We're already at 91 now, so it must be.
Well, hi everyone. We're just gonna wait just for 1-2 more minutes, and then we'll get started while everyone gets on to our live webcast with Alex Cook. Some of you guys are probably just scrambling from the live feed that we just had, live streaming on YouTube. So welcome everyone.
So 209 registered.
209 registered for today. So we've got 103 people who've just come on. We've got to wait for another 106 people. Well, we'll just give it a few more minutes, then we'll get going.
And guys, so we know you can all hear us, just jump into the chat, say where you are, what suburb you're in, because I'm sure I know you guys are in the unfortunate position of being locked down there in Victoria, unlike us New South Wales people who are set free. Sam in Mulgrave, g'day Sam. Thank you.
Apparently there's mandatory masks being worn now in Melbourne. So anyway, everyone can hear, that's good. Everyone keep typing because that's probably where we are.
Cool.
Yeah, where you guys gonna put your questions and everything. Hi Damien, hi Jennifer, hi Daniel, Simon Miller, Iron Man.
Excellent.
Everyone.
Okay, we're up. It's still going. So there's still plenty of people jumping on.
Yeah.
So maybe give them another more minute or so.
Yeah, we'll give them another minute. Hi Daniel Young. Hi Gwen, Desmond. Good to see you guys. Well, not see. I can't see. I can see your name. I like your backdrop, Alex.
Yeah, it's not my room, by the way.
No, I think that picture right there is that's what your room looks like, doesn't it?
I thought you were referring to the slide for a moment. That's not my bedroom.
Pete Chan asked also, are we auto muted?
Yes. Yeah.
Yes, you are, Pete Chan.
31. Yeah.
Hey, Robert. Great. Okay. Well, I think we should get started. Yeah, Alex, what do you reckon?
Sounds good.
Yeah. Okay. I look very handsome. Thanks, Pete. You look handsome too. Okay. Well, hi everyone. Well, welcome to our very first webinar. And just in case there are those people who are actually registered for this webinar who are attending this for the first time and haven't heard about who Alex is. So let me just introduce Alex and then I'll hand it over to him. So Alex wears two hats. First of all, he's a licensed financial planner and he runs a financial planning business. And the second hat that he wears is being the founder of a ministry called Wealth with Purpose. And so in this webinar, we're partnering with Wealth with Purpose, which basically brings a biblical education in the area of finances. And so today, the discussion we're having is to provide that for you and not personal financial advice. And if you want personal financial advice for your specific situation, you should go seek it out. But otherwise, just really want to say welcome, Alex.
Right. Thanks, Chief. Great to
hand it over to you.
Again, last time it was in the flesh, but a year ago now. But thanks to technology, we can all still see each other, so that's great. Excellent. Okay, so get started?
Yeah, go for it.
Okay, excellent. Well, welcome everyone. It's great to be with you again. Some of you, I think I would have met, I think it was June last year when I was with you guys down in Melbourne. Yeah, looking forward to sharing some more things with you. We've caught today getting your house in order. When it comes to money, it's an area where many people struggle. They kind of have a sense of, they could be doing better. or that they're a bit disorganized and they want to know how to get ahead, if you like, and to steward well what God has given them. So the focus for the next hour is actually all about getting your finances in order. Next week's presentation that we're doing is quite different. That's more going to be around how you make a real big difference with your money that God has given you. So just a few bits and pieces. As Chi said, we're a stewardship ministry. We focus on teaching what the Bible says about money, but in a really practical way. And that's our goal, is to help people have a kingdom mindset towards their money, so they can use it to glorify Him. We want people to be financially healthy first and foremost, and then we want you to do well with your money and be able to do good things with it. My background, as Chi said, I've been a financial planner, so I've been giving advice since about 1998, I think it is. And so what I bring to this is, as I say, the biblical side of it, but also the practical side. So how do you put those two together and make sure you manage money well? Just a disclaimer, we're going to have 2 Q&A sessions during this webinar. So roughly halfway, we're going to pause and you can ask as many questions as you like. And then we're going to do the same thing again at the end, okay? So feel free to scribble down questions as we go. The only disclaimer is that today's purpose from both Chi's perspective and mine is that it's education. So I'm not here in the context of advice, trying to give you specific advice. We're not talking about products or anything like that. However, I would encourage you to ask any possible question you want. No questions off limits. But if it is very personalised to you, I either might not be able to answer it, or I'll have to answer it in a very general way. Because as I say, today is for education and to really empower you to manage your money well. So a bit of an agenda and things that we want to go through this morning. Obviously, COVID's come along kind of out of the blue, and it's reaped havoc across the world with many economies shutting down. Barely planes have come to a grinding halt. The world seems to have changed overnight, and now as churches, many of us don't even meet in a physical building anymore. So there's some big challenges that's presented, and I want to unpack some of those from a financial perspective, things that have already sort of happened in the last couple of months, but also what may happen in the future, touch on that. And then what we want to spend the bulk of the time doing is talking about getting your financial house in order. How do we manage money well? And I'm going to talk to you about what we call the building blocks of financial health. And we won't be able to go through all of them just simply because time constraints. We could literally be here all day, but we're just going to focus on a few key things that I think will really help you to get your finances in order. Next thing we're going to do is have Q&A halfway, and we're going to do that also again at the end as well. So feel free to write down your questions as we go, and we'll attend to as many of those as we possibly can. The idea is we finish around just after 12:15, and then we'll have Q&A for more time after that. So we'll get through as much as we can.
Yeah, so Alex, just really quickly. So if people want to write their questions, they just go to the chat and they just type it in. Is that what they do?
They can do that. Or there's also a Q&A function that most of them will have on their screen on the menu. If they click on that Q&A, they can type in there and type in their question. I can see that as well. So both are fine. A question about, is it being recorded? The answer is yes, and I'm more than happy to provide that for you later as well. So we'll provide... I think anyone that's registered will have their email, so we can email that to you very easily.
Yeah, and the second thing is that we're going to have a Q&A halfway and then later at the end. So we're worried it's going into lunchtime. Some people have kids and stuff like that. So if you need to go off, then that's the time, you're more than welcome to. But that's why we position it. And so for those who need to can stay a little bit longer for the Q&A, you're more than welcome. Yeah.
Excellent. Okay, so let's just chat first initially about what's going on with this whole COVID-19. Obviously, job loss is the big thing that's hit. I mean, we've had the bankruptcy of Virgin Airlines. Qantas, I think, has laid off more than half its workforce, and quite another 2/3 is still on furlough. So there's a massive amount of people who lost jobs. And of course, many small businesses have shut temporarily, and some have shut permanently. So there's a significant job loss, and I'll go through some of those figures in a moment. My gut feel with that is, unfortunately, we're probably only at the start of it. I think that will get worse. There's a lot more companies that will be laying off staff over coming months. So that has implications for our finances in terms of making sure we're prepared for a rainy day. And we'll touch on that. One thing that's been a characteristic of Australia for the last few years, and even more so now, is low wage growth. There's a whole range of reasons why that's been the case, but that is a characteristic of something that's been going on for some time. The debt levels we'll touch on as well. Debt levels in Australia are astronomical, and we're the second worst in terms of the world, in terms of household debt. Immigration's an interesting one. So I think immigration now has dropped 98%. They say only 600 people are coming into Australia per day. So just 2 planes worth. Now, normally in Sydney and Melbourne, you'd be getting probably 100 plus planes per day of people. Now you're only getting 2 plane loads worth. So it's absolutely fallen off a cliff. And that obviously has had widespread implications on certain industries. The big one being tourism and accommodation, all that kind of thing. But also it affects house prices, which I'll come to in a moment. We'll talk about why that's going to affect that area. But the other characteristic of Australia, which has been a trend over the last 20, 30 years, is interest rates have just gotten lower and lower and lower. And that affects people in different ways. For some people who have a mortgage, that's been a blessing. Those rates have plummeted. I mean, to be honest, if you'd asked me 10 years ago, if you'd ever see a home loan with a 2 in front of it, I probably wouldn't have believed you, but that's where we are. In fact, I think I saw one bank the other day at 1.99%, just mind-boggling. But it also has big implications for retirees. So maybe you're listening to this and you've actually stopped work and your savings are now earning 0.5% in the bank. So that has implications for you as well. So we're all affected in different ways. Just want to touch on unemployment first. So I just want to paint a picture of what's going on, that's all. So there are 2 types of statistics here. There's what we call the official statistics from the Australian Bureau of Statistics. And then there's Roy Morgan. Roy Morgan is a research company. It's been around a very long time. I think their figures are much more accurate, and that's why I use their graphs. And they actually quote themselves and the government, so you can get a feel for how things are going. So official unemployment rate in Australia at the moment is a bit over 7%. Roy Morgan, their view, based on the way they calculate it, is it's actually 14.5%. And the government, so the Treasurer, Josh Frydenberg, actually came out and said it is actually double what the official rates are anyway, so he acknowledged it's much higher. And unemployment, the reason why the official rate is so low is that if you work just 1 hour in Australia, you are classed as employed. So you might not be earning enough. You might just want to do 1 hour, in a casual job, but that means you're not technically unemployed. Then we have what's called underemployment, and this is a much bigger issue because you have those that are unemployed and out of work, but then you have people who have a job, but they're not getting the hours they need, or they're self-employed and their revenue's fallen. So that figure is much, much higher. So you can see there, it's about 20% when you allow for unemployment and underemployment, and Roy Morgan's figures suggest it's much higher at 24%. Back in March, when we had a massive shutdowns, it was actually 27%. So it's actually improved a little bit since we've opened back up again. Obviously, you guys in Victoria are going to see all sorts of things over the coming weeks as you guys are in lockdown and the impact that's going to have on businesses. I think that the reality is unemployment, think of it like this. Unemployment goes up in the elevator, so it goes up very quickly, and then it comes down in the escalator, okay? So it comes down slowly. And so it's unlikely that unemployment is going to come down very quickly or very soon. It's probably more likely that this is going to be high unemployment for the next 2 to 3 years. It'll take time to recover. It just doesn't come back quickly because businesses have time to get back on their feet and so forth. So here's some of the implications. So this is the thing to get specific to you guys. Here's the thing, is your job personally at risk? And you may or may not necessarily know that, but is your job at risk? The second thing here from a financial perspective is, have you got cash reserves to last 6 months? When the global financial crisis hit 12 years ago, in America, it hit them much harder than it did us. And it took 180 days to find a job in America if you were put out of work. So in Australia, that never got that bad. But the thing is here, as a financial planner, one of the things we typically tell people is to try and have 6 months worth of cash reserves. So that way you are covered in the likely time it may take you to find more work. Obviously, the industry that you're in may be affected in far greater ways. So for example, in tourism, some jobs may never come back for the simple fact that those businesses may be permanently closed. And if maybe it's in things like restaurants and cafes, some of those will be permanently shut. So here's the other question is, do you need to reskill? If your job, you feel it's vulnerable, do you need to reskill and learn a new trade, so to speak, so that you can flourish and do other things? And the other thing also is to always involve God in this sort of decision making and say, well, you know, where is God potentially leading me? The other thing is, and this is more bigger picture, this is not COVID related, is that we're going through this massive change in the Western or globally with automation, and many jobs won't necessarily exist in 10 years anyway. So are there opportunities for you to reskill and go in a new direction? So these are some of the things that we really need to be pondering to make sure that we're prepared financially and getting our house in order, so to speak, and protecting our families. As I mentioned before, debt is a massive issue. Now, Australians have a love affair with debt. We are the second most indebted households on earth. If you look at this graph, it actually looks like we're the highest. That's just because they haven't included Switzerland. Switzerland is the worst, followed very closely by Australia. If you look at other countries, even Canada and New Zealand, they've got high debt, but substantially lower than us. Our debt is off the charts. Most of that you'll find is in house prices. Australians borrow huge amounts of money for their houses, and our houses, particularly where you guys are in Melbourne and Sydney, are where house prices are some of the most expensive in the world. And that has all sorts of implications. So the first one is, once again, coming back to the COVID situation, how long could you pay your debts for if you lost your job? Okay, so think about your mortgage, if you have one. How long could you last without a job? Now's a great time to be building up cash reserves. Now, if you have a mortgage, you might have what we call an offset account, which is a savings account linked to your mortgage, and that could be a great time to build that up so that you've got a strong buffer if if you lose your job. Another question to ask yourself, is your debt too high? What I've found over the years of giving financial advice is some people come to me and their debt levels are just simply too high. Now, there's a couple of different ways you could measure this. One would be to say, is more than 30% of your income is going in debt repayments. Once you get above that, it's deemed to be mortgage stress, but also it just becomes hard to live a productive life, in the sense, as Christians, we're called to be generous. If you've got more than 30% of your income going out the door in the form of debt repayments, it's hard to live a generous life. So to get ourselves in order, we want to make sure our debt levels aren't too high anyway. So just keep that kind of thing in mind. The other thing is, it could be a good opportunity to refinance your mortgage and get much lower rates, and particularly potentially, normally, and once again, this is not advice because we don't know the future, but given interest rates are so low historically, maybe it's a chance to fix your rate at a much lower level than you've ever had in the past. The other comment to make is avoid the lure of low interest rates. There are a lot of people out there, particularly whether it's real estate or banks and so forth, that want to lure you in on low interest rates. What I mean by that is they're trying to encourage you to take on massive levels of debt. Because debt seems so cheap at 2%, we think, oh, wow, I can get it cheap. But here's the question to ask yourself. If interest rates were to rise significantly from here, what impact would that have on you and your family? So when I say to people taking out a home loan, imagine you're earning, imagine interest rates are actually at 8% on a home loan. Now, interest rates on home loans have been 8% in the past. In fact, if we look at ING Bank, they're one of the few banks that operates in Australia that actually uses 8% as their benchmark. So you can't get a home loan with ING Bank unless you can afford to pay that debt at 8%. The other banks are much lower. They're at like 5%, which I think is crazy because it means that they're taking on much more riskier customers. So here's a good test. If you went to ING and asked them for a home loan, would they give you one? Okay, because rates, don't get sucked in by lower rates and into borrowing a lot more money than you have. So that's just some of the implications there. The other question that I always get asked is where to for house prices, given what's happened with the coronavirus. Prior to the election in May last year, so Morrison getting elected, house prices had already fallen about 10-15% across Sydney and Melbourne. That was due to a range of fears around removal of negative gearing and so forth, and the fact that they were very high. But the question is, what will happen to house prices now? And I'm sure that's a question that some people have. First comment to say is no one knows the future, right? I can't sit here and predict what will happen, but I do have certain concerns. One is the lack of immigration into Australia has had a big effect. And one of the big effects is that many people and investors had their properties on Airbnb. Those properties are now vacant and have now become long-term rentals. So as a result, rents, particularly in Sydney and Melbourne, have plummeted. In some cases, they're off 7 to 10%. And therefore, if you're an investor, many people are losing money. In fact, 1/3 of property mortgages, as in property investment mortgages now, have their loans deferred, which is a staggering amount of that. But as I say, vacancies have gone up now. Property in Australia was already very expensive relative to the world, so very overvalued. Banks are now tightening credit, so they're getting nervous about lending to people. And in some industries, like airlines, they just won't lend to you at all. Obviously, the higher unemployment is likely to be there for a while. In total in Australia, and this is a staggering, 900,000 loans have been deferred. Now that includes credit cards, car loans, etc. But in terms of home loans, that's 900,000. It's over $200 billion worth of loans have been deferred. Now, when all these JobKeeper programs and Job Seeker, these government stimulus, when they subsided in September, the million-dollar question that no one really knows the answer to is, what will that do to the real unemployment rate? And what will that do to people defaulting on these loans? It's hard to predict. Then, of course, the other issue, particularly for retirees, is the dividends are falling. So people who are very reliant on their income from their investments, that's falling as well. So the Australian banks, of the 4 major banks, 2 of them have cut their dividends to 0. One has cut it by 2/3 and the other's the only one that's still maintained it. So people's incomes have fallen quite a bit. And as I mentioned, wage growth is almost non-existent in Australia and really has been for years. So these are some of the implications. So think about, maybe you're a property owner. Maybe you've got a chance to refinance and get lower rates. If your debt's too high, maybe you need to think, maybe I should sell now before things get worse. For those of you who are property investors, maybe you're thinking to yourself, if you're negative cash flow, should I be holding that property for the long term if I'm getting negative return on a cash basis? And for those of you who worry about your job, obviously you need cash reserves and so forth. So these are some of the things that are going on that we really need to think through carefully and ask, how will they affect myself? How will they affect my family? And how will that affect our lives and our ability to manage money well and to steward it for God's kingdom? So that's a bit of a COVID background. And I'm happy to address a lot more of those issues in the Q&A. So if you want to unpack any of those more, happy to do that when we have the Q&A section. But now what I want to do is jump into really the gist of getting your house in order. These things here are what we call the building blocks of financial health. I'm going to focus predominantly on the ones at the bottom, things such as a bit about your mindset towards money, how you spend your money and get control over it, protecting your family, making sure you're insured. We'll touch very, very briefly on the spiritual side. Certain topics we just don't have time for, so I'm not going to talk about estate planning. We will talk on debt and saving and having an emergency fund, particularly given what's going on, and things like investing and the relationship side of money and giving and ongoing learning. We're not going to talk about today. Some of that we will cover next week, but for the most part today, I want to focus on what I call the building blocks. These are the things that you need to have in place to ensure your finances in order. So these are things I want to touch on briefly this morning. Your mindset, your spending habits and how you control your spending, and how you maximize it properly, dealing with your debts, saving, and obviously making sure you've got an emergency fund and reserves and so forth, and protecting your family, like making sure you've got the right insurances in place. So we'll touch on each of these. Some I'll spend more time on than others just because we've got time limitations obviously today. So first thing is making sure our mindset is right. The thing with our mindset is how you think about money will determine how you behave with money, okay? And how you behave with money will determine your financial future. So one of the key things as a Christian is the idea that everything I have is God's. all the money I have, it's not mine, it's God's, and that I need to steward it for his kingdom. Okay, that's the first thing we need to get right. So I use this simple analogy, which you may have seen me use before, and that is stewardship is managing God's blessings in his ways for his glory. So we acknowledge that in Australia we're enormously blessed. We're not necessarily doing it his way though, and that's an area where we need to work on to get our house in order. And then we want to use our money for God's glory. So having that kind of stewardship mentality. And we need to fight against our culture, because our culture says, and this is a quote from a guy, Clive Hamilton, who said, most people spend money they don't have to buy things they don't need to impress people they don't like. And whilst that's kind of funny, it is very, very true, unfortunately. And what we need to do is replace it with a kingdom mindset. And here's a quote I love from John Maxwell. Many of you guys would have heard of him. He's a Christian leadership expert out of the US. And he's written this great quote about the problem with money. And he said, when it comes to money, you can't win. If you focus on making it, you're materialistic. If you try to make it, but you don't make any, you're a loser. If you make a lot and you keep it, you're a miser. If you make it and spend it, you're a spendthrift. If you don't care about making it, you're unambitious. If you make a lot and still have it when you die, you're a fool for trying to take it with you. The only way to really win with money is to hold it loosely and to be generous with it to accomplish things of value. So coming back to the mindset issue that I want to impart here, we want to understand that our money is God's and that we need to hold it loosely. It should be like a river in your life where money flows through you, and that we live out and live generously with it. Therefore, we need to say, is what we believe about money true? Is it biblical? Is it accurate? Do we believe that we need debt to create wealth? And I'm going to touch on debt more. Do we believe that money is simple or complex? Do we believe in retirement? As a Christian, I don't actually believe in retirement. I believe that you run your race to the end. That's not to say that you don't retire from paid employment. You may change what you do, but the important point is you get up every day on purpose as well. So that's the first thing, getting our mindset right. Now, step 2 is have you saved for a rainy day. So we touched on before, unemployment can last for quite some time. And many of us may find our jobs at risk, or our business, maybe you're self-employed and your business revenue has fallen. During the GFC, as I mentioned in the US, it took on average more than 180 days for people to get a job if they lost their job during the crisis. Because of the lockdown again in Melbourne, and I think it goes for 6 weeks, there'll be some people who are literally out of work and won't be able to get a job after the crisis once the lockdown comes up, because things will be, that particular business they were in is still struggling. So you've got to be mindful it can last a long time. So what I would always suggest people have as a financial planner is an emergency fund. Now, some people would debate how much you should have. I generally suggest you have about 6 months worth of living expenses set aside. Now, some of you might panic and go, Alex, I've only got 1 month, and that's okay. What I would encourage you to do is to build that up. Try and save a certain portion of your income so you can build up your emergency reserves. In fact, one thing I say to people is just go on Gumtree, flog off a few. If you've got any excess things around your house that you no longer use, start building up that reserve straight away. Now, the other question is, what do I do with it? Where do I put it? Well, it should be highly liquid. That is, it should be in things that you can get access to very quickly, i.e. a bank account or a term deposit that can be broken within 24 to 48 hours, i.e. you can get the money very easily. But it does need to be set aside, so it's kind of a bit out of sight, out of mind, and you shouldn't have ATM access to it. So the idea is it's money you don't touch unless you really have to. Anything that's with an ATM or easy to get to, you're likely to spend. So what we're trying to do here is isolate this money, save it for a rainy day to protect it. Now, some of you might say, Alex, I've got a home loan. What should I do? Well, most home loans in Australia will give you the option of having an offset account. And with that offset account, what you can do is use that as your emergency fund. In fact, some banks allow you to have multiple offset accounts. And so what we get clients to do is set up a few different accounts. So one could be like a holiday account, one could be their emergency account, one could be account for long-term savings or just for reducing the mortgage at some point in time. So you have that money in your offset account, reducing the interest on your home loan, but you've still got a reserve. So you've got money you can access if you lose your job. So that's a few things there. So that's step two. So first step, get your mindset right and aligned with biblical thinking that your money's God's. And step two is, as I say, have that emergency fund. Step three is get control over your spending. This is probably the biggest challenge, I think, for most people, is getting their spending under control. The savings rate, when crises hit, the savings rate usually goes through the roof. But prior to it, the savings rate in Australia was about 1%. We're not great savers. That does differ by cultural groups. Some cultural groups are naturally better savers than others, probably because of history, economic history in their countries. But for the most part, people struggle with it. And so we need to have a spending plan, and that's where you want to have a budget. Now, what is a budget? Well, very simply, it's how much money is coming in versus how much is going out, okay? And what we want to make sure is more money is coming into your house than is going out, because if more is going out, then of course you're in deficit, okay? So what is a budget? Well, as I say, it's money coming in versus money going out, and it's a tool to project the future. So you want to be able to see what your expenditure is likely to be over the next 12 months. It helps you to become self-aware, become aware of how you're spending your money. Are you using your money for good things? Are you using your money for eternal things? Are you spending money on areas that really are a waste, etc.? So it's a tool of awareness. It helps you to prevent financial shortfall. So it'll help you make sure you're not spending more than you earn. It'll help you achieve your financial goals. And it's also a tool of conviction. It helps us as Christians acknowledge whether we're using our money in good ways. So how do you do it? Well, on our website, you can download a budget planner, and I would encourage you to go to that. So because of time limitations today, I don't want to go into too much detail on some of these things, and we can unpack it more in Q&A. But the main thing here is gather all your documents, whether your bank statements, your credit cards, your bills, and actually look at how you're spending your money. And what you want to do is put it into a spreadsheet. And there are actually some good apps as well. I use an app called Money Brilliant, but there's all sorts of other things you can use as well. And you want to track it. You want to then document exactly how you're spending your money. So firstly, you want to know how much income's coming in. So for most of us, it's things like we've got a salary or a wage, dividends from shares, maybe you've got an investment property, you've got income coming in from there, interest on bank accounts, whilst that still exists. You might have a bit of that. And then some of you might have some social security as well. So we want to know all our income sources. Then we want to know all our expenses. So how are we spending our money on our mortgage, our rent, our car, insurances, all that kind of thing. You'll notice at the top I have giving to God. The reason why I do that is simply what I find is many people put God last. So as Christians, we say God is first in our life, but often when it comes to our money, we put him at the end. And it should be the other way around. We should work out our giving to God first. How are we going to honor God with our finances? And that should be first and foremost when we do our budget. We also want to work out which of our expenses are fixed. These are things you absolutely have to pay versus things that are variable, which are things that you don't necessarily need, such as your Netflix subscription or your Foxtel, etc. Then we want to put it together. So here, let me give you some key steps here for putting it together. Firstly, we want to record our income, so income coming in. Then we want to record our expenses. And then we want to calculate our surplus or our deficit. Now, this is the most important part. Let me say this, your surplus and what you do with it will determine your long-term financial success, okay? So let's make up a figure. Let's say $10,000 a month comes into your house and you've got $8,000 of expenses. So you've got a surplus of $2,000. What you do with that surplus of $2,000 will determine your long-term financial success and financial future. If you're in deficit, so say you've got $10,000 coming in every month, but $11,000 is going out, then you're in deficit and you're going backwards and you're probably accumulating credit card debt. So we've got to know what our surplus is. That's the key issue here, and make sure that we're doing wisely with it. We're saving it, etc., or giving it. We also want to calculate each expense as a percentage of our total to make sure we're not spending too much on any one area. So we're not spending too much on our mortgage, not too much on certain things, like entertainment. As I mentioned before, expenses are fixed versus variable. We then want to analyze our budget, make sure that we are doing it well, and maybe there's things that we need to adjust. We need to either adjust our expectations or we need to adjust our expenditure. So we need to cut our costs, etc. So there's a simple sort of formula for you to use. And as I say, on our website, you can download a budget planner and get access to that kind of thing. And really what you want to ask yourself here is, does my budget honor God? Which of these expenses are essential? Are there things I can do without? Does it reflect contentment, or am I trying to spend money just to make myself feel good? And what will I do with my surplus? These are the things that people need to think about. Now, the common thing people ask me is, Alex, they say, Alex, well, that's all well and good, but what does a good budget look like? Well, we have a simple formula called the 80-10-10 rule. That is, first 10% for giving to God, second 10% for your long-term saving, and then try and live on 80% of your income. So rather than living within your means, you live beneath your means. The way you get ahead financially in life is by living beneath your means, okay? You'll notice here I said accommodation expense should be under 30%. So typically I say that either your mortgage or your rent should be 30% or under. If it's over that, then you're probably spending too much in that area, and it will be hard to get ahead. And obviously with your mortgage, if interest rates rise, that could go from 30% of your income to 40%. And I've met over the years plenty of people who have got 50% of their income going out in mortgage repayments, which is just way too much. So that's a simple formula for use. Giving to God 10%, and these are guides, they're not meant to be legalistic or rules, but it's meant to be just useful parameters for you. Now, lastly, before we have a Q&A session, people say to me, Alex, I've done a budget, but I still can't save. And part of that is it comes back to behavior with money. So it's one thing to think the right things. It's another thing to behave well with money. Okay. And so what I encourage is a bucket system. So if you think about having a couple of different bank accounts and think of them as different buckets, and there's three key categories that I would look at: a spending category, a storage category, and a savings category. Now, what do I mean by all of this? Well, a spending category is money you're going to spend on a month-by-month basis. These are things like you've got to pay your bills, and then you have your day-to-day living, like such as you're buying a coffee sort of thing. Then we have storage accounts. These are for things that you're going to spend in the near future. So it could be for gifts, could be for holidays, things like that. Maybe you're going on a family holiday, it's going to cost you $2,000. You set that money aside for that time. Rather than doing what a lot of people do is they book their holiday and then they put it on the credit card, and then they come back and then spend months paying it back and paying interest unnecessarily. So you want to avoid doing that. And then the last category is the long-term saving. So this is things like saving for your first home, having your emergency funds, and saving for retirement. So think of it in those three different categories. We want our spending bucket for today, day to day, our storage bucket, and our savings bucket. And you may have multiple accounts within those. Now, my view is you want to keep your money simple. You don't want to overcomplicate it, but you might have some for your everyday spending, some for your bills. Then it may have accounts for future things like holidays, and then your emergency fund as a separate thing, okay? So different buckets for different purposes. And what this does is it helps you to get control over your finances and isolate the money and behave better with it. And what you want to do, of course, is limit your day-to-day spending. And by setting money aside for emergencies and for retirement and for other things, you're locking that money away and trying to get it out of your hands from a day-to-day perspective. So that's having your banking system and structure in place. Okay. So how do you make it work? And also with these buckets, you want to automate it. So one of the common things is you get paid, let's say you get paid monthly, you get paid on the first day of the month, automate. So 10% of your income automatically goes out and goes straight out to your long-term savings account. So you're forcing yourself to save. The other thing I always say to people is cut up the credit card. Credit cards are such a temptation to spend money, and just use a debit card instead. Because remember here, ultimately all that matters is our behavior. How we behave with money determines how well we're going to do with money in the end. So we're going to pause there now. So we're just over halfway. What we're going to do is have Q&A, and I can see there's some questions coming in already. In fact, there's, okay.
Hi, Alex. There was one that was in the live chat. Can I put that forward, because it's in terms of line of priority? Yeah, in terms of when it came in. What do you think about the barefoot investor?
Generally speaking, very good. Obviously, he doesn't come at it from a Christian perspective, but he does still promote generosity and so forth. But what I like about the Barefoot Investor is it's good, simple practices. You know, he's all about the practical management, and it's just good, simple things for people to put into place. He also talks about that bucket-based approach that I just mentioned, where you're trying to take control over your money. And he encourages also people to cut up their credit cards and get out of debt. So generally speaking, I think the Barefoot Investor is a good thing as a general rule.
Okay, great. Yeah, so in terms of measuring jobs and employment, is it helpful to consider the number of jobs advertised as well? Do you have stats on that?
Yeah, great question. So each month, that website, that's a big job website, I think it's called Indeed.com, they release their figures. And jobs, during COVID, job advertisements fell 50%. I think we're back up now to about 75%. That may slow down again. I think that'll probably dip again, particularly in Victoria, because you guys are in lockdown. But yeah, so it's about 75% of what it was before in terms of jobs advertised. That's actually a useful one as well. It's a useful guide. I mean, you've got unemployment, you've got all these different figures, and they all tell you a slightly different thing. But the reality is, the other thing is, I believe the number of people going for jobs, it's about one. There's about one job for every 12 people applying, I think, at the moment. It's quite high. So yeah, there's all sorts of things you can follow, but the jobs advertiser is a good one. And the company that puts it out every month is Indeed. In fact, I think Seek does it as well. I think they've got figures that they put out every month. On a working visa, do you think FBIT will be reduced to encourage home purchase? You'd have to explain to me what they mean by FBIT. I'm not sure I'm familiar with that expression. It sounds like a government grant or so. Yeah, I don't know what FBIT stands for. I'm not familiar with that acronym.
We'll come back to that.
Yeah, we can come back to that one. Yeah. Okay. A question here. Is it a good time to be buying your first house, and would it be better to wait and continue renting? Look, this is a really common question and common thinking. And I want to give you, I guess, two answers to the question. The first thing is, both biblically, is no one actually knows the future, right? You should be always a bit nervous listening to economists, because you can have two PhD economists who tell you two different things. In fact, there's a joke about economists that says you could line up all the economists of the world end to end, and you still wouldn't reach a conclusion. So the point is that no one really knows. In saying that, there's a couple of things I would say. Firstly, house prices in Australia, particularly in Melbourne, where you guys are based, are very expensive and very overpriced. There's also a massive oversupply of apartments down in Victoria, I believe, particularly that Docklands area and so forth. So there's a massive oversupply. Unemployment is likely to rise a bit further from where we are today. Interest rates are record lows. So in reality, at some point, they're going to go up. So you have to say to yourself, can I survive in a higher rate environment from today? The other question to think is, do you have a big enough deposit? I always encourage people to have as big a deposit as possible, so you borrow as little money as possible. But I think my personal feeling, with immigration now gone to practically zero, I suspect house prices, and I'm not the only one saying this, but I suspect house prices will fall quite a bit. I'd say they'll fall a minimum of 10%. Others are suggesting more than that. But my view, a minimum of 10%. So does that mean it's a good time to buy? As I say, no one knows the future, and I can't tell you whether it is or it isn't. But I certainly think things are going to get weaker. I think that things will get worse before they get better. That's probably how to answer that question. As I say, no one knows the future. That's the disclaimer. Okay. What's the best percentage for self-education upskills on our saving bucket? I'd probably answer that question by, it kind of comes down to stage of life. Like when you're young, I think you're spending a lot more on self-education and upskilling. unless obviously you're in a transition phase where your industry is being phased out because of, you know, the way the world's going. But I don't have a specific percentage for you as to how much you should spend on self-education or upskilling. The only comment I would make is it's really going to come down to an investment in your future. So if you're going to do a course that's going to lead to either, you know, higher wage or a new occupation that's going to last for a long time, then it's worth investing that money into. I think where you have to be careful now, and the government, I think, is cotton on to, you might have noticed in the last few weeks, the Australian government has doubled the cost of certain degrees. And the reason they're doing that is because they've said that those degrees are unlikely to provide people with good jobs. So they're actually bumping up the cost to make it less attractive for people. But I think it's worth investing in yourself so that you can upskill and potentially have a higher paid job and so forth, or to go into a job that you feel more importantly, God is leading you into. But I wouldn't want to allocate too much of a percentage to it, as in being too concrete, because I think that'll be driven by your age to some degree as well. I hope that answers that. Okay, question about the Money Brilliant app. So look, there are lots of apps out there people can use on their phone. So the one I mentioned before was Money Brilliant. That's one I use, but there's lots of them, and you can try them out. One of the questions, and you can add your bank accounts to it, and it gets a data feed from your bank. There's a question about privacy issues. Is it safe? The answer is I can't give you any guarantees. Of course, they all say they are, and there's encryption and that kind of thing. There was an article actually in the paper the other day saying that if you use some of these third-party applications, you may not be protected by the bank if someone was to hack them, because the bank would say that you've given out your password to a third party. So I do think you do need to be careful about which apps and technology you use, but not putting aside the privacy issues and the safety issues, which are very real, as in you need to do your homework here. They are very good tools of tracking. Because it's all automated, it means that you're actually getting just live feeds, and it makes tracking a lot easier. So yeah, so I encourage them, but as I say, do your homework on the privacy issues, etc. What else we got here?
Probably one more, Alex, and then we'll probably should go.
We're gonna. I'm happy to stay on at the end, so we can talk as long as for people who want to hang around a bit longer. Probably a relevant question here at the moment. What's my thought on people withdrawing their super early for buying property and investing? Mixed messages. You see mixed messages, and some friends have been doing this. The important question, because a huge amount, I think about $19 billion has been pulled out of Australian super funds in the last few months, because the government said if you lost your job, or I think it was your number, there was a bit of a criteria around it, eligibility, but mainly redundancy. If you lost your job, you could withdraw up to $10,000 in the financial year that's just ended, and another $10,000 in this current financial year. So up to $20,000 you could withdraw. So a couple of comments about that. First things first, my view is if you don't need the money, don't withdraw it. Even if you've lost your job, if you don't need it, don't withdraw it, because that's going to have a big long-term effect on the compounding effect of that money in your superannuation. So if you don't need it, don't take it out, would be my first piece of advice. You mentioned that some people are taking the money out to buy property and invest. In one sense, that doesn't make a lot of sense, because think of superannuation as a vehicle, a low tax vehicle for investment purposes, because you can invest in shares and property via your super fund. Obviously, it depends on how much money you have, but you can invest in those things via that. My key message I want to get across here is I'd be very reluctant for people to take out their money of super, because it is a long-term investment. and it has a compounding effect that will grow if you keep the money in there. And you can invest in your super fund in shares and real estate anyway. So I generally try and avoid taking it out unless you really have to. It's really been designed by the government. You only take it out if you're actually in financial hardship.
Alex, maybe just the last question, just to close the question with. So he put down at the bottom, foreign buyers investment tax, Victoria tax 8% on top of stamp duty. That was
Okay. Yeah.
Maybe we can answer that, and then we can defer all the other Q&As until the end after your next segment.
So the question then becomes, so I'm just trying to find his note here. It's on the chat, is it? Or?
Yeah, it is on the chat. So his question is, I am currently on a temporary working visa, a worker's visa. Do you think the FBIT will be reduced to encourage home purchase? So is that tax going to be reduced from, I think, 8%? Yeah.
It's a great question in one sense. The way I'll answer the question, because the answer is I don't know, obviously, because it's predicting the future. However, the way I'd answer it is this: the government does not want house prices to fall. Okay, because if house prices fall, it has a very negative effect on stamp duty revenues for state governments. So state governments want high house prices, and so if they don't want to see it fall. That's the first thing. The federal government doesn't want to see house prices fall because they see it as partly as an election issue. In other words, if house prices fall and people are underwater, then that they think there's less chance of them getting elected. So it's in both the interests of the federal government and the state governments to keep house prices high. I don't actually morally agree with that because I actually think we want house prices lower so young people can buy houses without becoming slaves to their mortgage. That's my personal view. But that doesn't mean governments operate that way. So what you will see, I believe, is governments are going to do whatever they can to stimulate the housing market. And they've already done that already with this. The federal government announced, I think they've called it the Home Builders Package. I haven't looked at the detail, but they'll give you up to $25,000 if it's investing in renovating your home and stuff like that. You'd have to look at the details. I'm just quoting it vaguely, but merely to say that governments will try and stimulate the housing market. The Australian housing market, in one sense, is the least free market of all because they keep bringing interest rates down, which pumps up house prices with more borrowing. And they come out with first homeowners grants and all these different grants, which are all designed to prop up the housing market. So expect governments to do whatever they can to keep the housing prices up, is how I'd answer that question.
Right.
That doesn't mean they'll succeed, by the way, but that's what they'll try. Okay, next section. Step 4, get out of debt. Couple of things here. So interest rates have never, ever been this low before. You can see this graph here of the Australian, what they call the cash rate, which is set by the Reserve Bank of Australia. It is now at 0.25%. Okay. Now, home loan rates, variable loans now, you're probably seeing ads for around 2.3%, 2.5%. It's never, ever been this low. Now, that has all sorts of flow-on effects that are unpredictable. One thing that has been predictable over the last 10 years is that as rates have come down, house prices have gone up because people just have more capacity to borrow. If rates are lower, they can borrow more money. Likewise, if rates go up, they'll have less capacity. But this has had a huge effect on retirees, particularly for me as a financial planner, where I'm trying to invest people's money. It's become harder and harder to get income for their portfolios in a low risk way. So it's a bizarre environment. But a wise proverb, so straight out of Proverbs 22 here, is it says, the rich rules over the poor and the borrower becomes the lender's slave. So a message that I absolutely want to get through today is please be very careful with how much debt you have. Because if rates rise, keep in mind, they're already at rock bottom. If they rise, and let's say they normalize back up on what they were here, around 7%, then what would that do to your finances if you have a large amount of debt, a home loan, etc.? How will that affect you and your family? Will you risk losing your home? Will it affect your ability to pay kids' school fees or just to live a generous Christian life? But just be very, very careful. The one thing the devil wants to do is enslave you, okay? Either you're enslaved to money in a spiritual sense, you fall in love with it, or you're enslaved in the practical sense that you've got so much debt that you can't get out of it, okay? So just keep that in mind, okay? Just be very, very careful. In fact, the word mortgage is actually a French word, and I often joke about this. The word mort equals death and gage equals pledge. So when you're entering into a mortgage, you're technically entering into a death pledge. There's a bit of history for you. But the point is it's very serious. Now, given the COVID times we find ourselves in, and maybe many of you do have a home loan. There's 160 of you on the seminar today, so there's a good chance that some of you have a home loan. That being the case, and given rates are probably not going to go much lower, I don't know how much lower they can really go. In some countries, hard to believe, but some countries have negative rates, like in Europe and Japan. And in the case of Denmark, it's the only country I'm aware of that has a home loan with a negative interest rate. Hard to believe, but it does exist. I don't think we'll see that in Australia, negative rate home loans. But the important point here is maybe it's a chance to refinance your house at a much lower rate and get interest rates locked in at a lower level. And that way you're setting yourself up from a cash flow perspective that if interest rates were to rise, then you're protected. So something to consider. The other thing is, given the debt levels, build up an emergency cash reserves in an offset account as your buffer. So if you've got a home loan, build up reserves in an offset account, so you're giving yourself protection. Credit cards, I'll touch on these briefly. I'm very anti-credit card. Credit cards have enormous interest, usually 18% plus, and effectively you'll spend roughly, if you owe just $4,000, you'll spend $790 a year in interest. And if you only pay the minimum that the bank requires you, which is about 3% per month on your statement balance, then it would take you 31 years and 15 grand's worth of interest to repay only a $4,000 debt. So credit cards are dangerous. So what I always recommend to people is try and switch to a debit card. You can still do all your online transactions, all those kind of things. I'd really recommend getting rid of the credit card altogether, because the convenience, this tap and go culture. I mean, I've got one of these Apple Watches. Who would have ever thought that you can just tap with your watch just to buy something? I mean, it's just crazy. So that convenience causes temptation. And the real interest rate is more like 30%, because what people don't realize, when they're paying the 18% interest rate on their credit card, you have to pay that out of after-tax money. And the average Aussie pays at least 30% of their income in tax, 30 cents in the dollar. And therefore, I think the real interest rate for most of us is more like 30%. If you do have a credit card, because you're still using one, then please pay the full amount every month, okay? Make sure you're always paying the full amount off. Never pay interest on your credit card, because it's dead money, okay? And it can be avoided very, very easily. What about a car? Generally speaking, I discourage people borrowing to buy cars, because what typically happens is we buy cars that are more expensive than we would have bought had we just used cash. They're a depreciating asset, so they go down in value very rapidly, and they're a money pit. You can spend a fortune on cars. The best advice someone gave me once was buy the cheapest car that your ego can afford. Okay. A lot of people, their identity gets wrapped up in the kind of car they drive and so forth. As believers, our identity is in the fact that we're precious children of God. So we've got to try and separate ourselves from the world in that sense, and try and avoid borrowing to buy a car. Just use cash, use real money, don't borrow. I do say there are some exceptions to that. Maybe you have an occupation where getting around in a car is essential. You're in your car all day as a sales rep or something like that. So I think there are some exceptions that I would say, but for the most part, try and avoid borrowing money to buy a car. So here's some debt tips. So here things are really important things to get at first, to consider. Firstly, pay off your credit card in full every month. Switch to a debit card. Avoid borrowing to buy a car, as I mentioned. If you're buying a home, because a couple of you already asked in the Q&A, you're interested in buying your first home, borrow 30% less than what the bank will give you. Because you have to remember, banks make their money by lending money. They make money through the lending process. And so they want to get you into as much debt as possible, so long as you can afford it, okay? They don't want you to default, but they want you to have enough debt that it takes you a long time to pay it back. Whereas the best home loan you can have is the one you pay back the quickest. So borrow less than what the bank will offer you. Because when people go to mortgage brokers or they go to banks, the first question they ask is, how much will you give me? That's the first question. And as a result, they then go and borrow the maximum. So what I would encourage you to do is borrow less than what they'll give you. Have a large deposit, ideally at least 20%. Given the current economic environment we're in, you might want to consider refinancing to get yourself a low rate, given some of the rates on offer are so amazingly low. And then the last thing is, I'd encourage people, when you're taking out a home loan, there is what we call principal and interest loans, where you're paying back the capital you borrowed plus interest, and there's interest-only loans, where you only pay the interest and you don't pay the principal. Whilst interest-only loans have appeal in the sense it's a lower legal obligation per month you need to repay, the problem is, what I've found with people when they take out interest-only loans, it's kind of like a giant credit card, and they don't pay back the principal. You need to pay off the principal. You need to keep chipping away at the debt and getting rid of it as quick as you can. So I generally encourage people to have principal and interest loans, so that way they pay off their debt. Particularly relevant for property investors, because a lot of property investors are what we call negatively geared. That is, they're losing money. The rent that they receive from their investment is lower than what they're paying out in mortgage repayments. So they're losing money every month. And that's a real problem if the property is not going up in value. So you want to make sure that you're paying off the value and you're actually at least building equity in that investment. So there's a couple of tips just to get you started.
Sorry, Alex, you don't mind me piping in just a little bit? This is for those who are listening, because I know some people will have different views on debt, and some people might go, oh, this sounds quite conservative. But I've listened to Alex quite a little bit now. And one of the things that maybe just to draw out your heart behind this, like you said before, the Bible doesn't say debt is a sin, but it discourages debt. Is that correct?
Exactly right. Yeah. So nowhere in Scripture do you find it being sinful. The main issue, I think, is it's really a wisdom issue, and being wise in not taking too much on. The passages of Scripture that relate to debt are really warning messages. So one Scripture suggests that you shouldn't guarantee someone else's debt, for example. And then the one I quoted before from Proverbs 22 is, you don't want to become enslaved to it. Okay, so what concerns me in our culture is that, we have a cultural obsession with debt. And the second thing is, interest rates are so low that at some point they will rise and then people will become enslaved. That to me is the thing that we should be concerned with. So yeah, but it's not sinful, and no one should feel condemned or feel guilty. But we just need to make sure that our motives are right when we go into debt, and that we don't overdo it.
Yeah, and there's a lot of assumptions, like you said, right? Some people make when they take on too much debt, that gets them into trouble, which is what you're alluding to. Yeah. We assume interest rates will never go up. We assume that, we always have our jobs. We assume that house prices will go up. And then when you're highly leveraged, then you're going to have a lot of problems. And no one expected COVID, but those who are debt free right now are the ones who are in a really healthy position. Yeah.
Exactly right.
Yeah. Yeah.
Cool. So step 5 in getting our house in order is doing things to make sure we protect our loved ones, our family. Protecting them in the event that something happens to us. Life happens. And so, what would happen to you and your family if you were unable to work again, i.e. you become disabled or you have an accident, or what would happen if you or your spouse died prematurely? And that's a big issue. It's one of those things we hope never happens to us, but it does happen. And the implication is, what would happen to our children or our surviving spouse if if something happened to us. That's the implication. And what insurances do we have in place?
Sorry, Alex, you're a bit soft. Someone's actually said, can you speak closer to the microphone? Thanks.
Hopefully that's a bit clearer. I'll talk as close as I can and talk a bit louder if I can.
Yeah.
So one of the other issues is, what are some of the risks? So for men in their lifetime, there's a 1 in 3 chance of getting cancer. For women, it's 1 in 4. And stroke, about 40,000 Australians a year have a stroke. And then, of course, the probability of having a stroke is, I think, 1 in 4 for men and 1 in 5 for women. So these are some of the figures here. So these are some of the risks, and they're kind of things where often we think, oh, it won't happen to us, or, you know, I'll live till I'm 80, that kind of thing. And we just don't know. But the important thing here is, how do you protect your family in the event that something happens that's unforeseen? And here's the thing, it's not the probability of it happening to you that is the issue. It's the impact on your life if it does. So what do I mean by that? Well, if someone is 30 years old and they're married, maybe they've got a couple of kids, the implications if one of them passes away is far greater than, say, a 60-year-old. If a 60-year-old, they may have paid off their home, their kids have grown up and moved out of home. The implications for the 60-year-old, even though the probability of a 60-year-old getting sick is far higher than a 30-year-old, the implications for the 30-year-old are much greater in terms of the impact, okay? So that's how we need to think about insurance. We need to be prepared on the basis that it's not the probability that it happens, it's the impact that if it does actually happen, how will it impact me and impact my family? So that leads to, what are the types of insurances there that we should have? There's a couple of things that we should have in place. So income protection, we protect our income. So income protection policies usually pay 75% of your income in the event that you're unable to work. So you become disabled, or you get sick, you have an accident, something like that. They will pay you 75% of your income until you can return to work. That's a really important one. It's also tax deductible. Then there's life insurance, and that's a really obvious one. It pays a lump sum if you pass away, and your beneficiaries will receive that money. Another one that many of you would already have through your superannuations, what we call total and permanent disablement. It's probably the one that's least likely to happen to you, but it's literally where you can never work again, okay? And they will pay a lump sum. A very common one, and I've had a few clients claim on this, is what's called a trauma policy or crisis cover, and it pays a lump sum on diagnosis. So the 3 most common things are heart attack, cancer, and stroke. But there's usually about 30 or 40 events that are covered through these policies, and it will pay you on diagnosis of those things. It has to be a certain degree of seriousness, but it will pay a lump sum. And then lastly, private health insurance, which I, generally speaking, recommend. In fact, we just did a webinar in fact, on our website, you can actually access it. A webinar on, is private health insurance worth it? Because a lot of people ask me that question, should I have it? Generally speaking, I am pro it, despite the fact that it's not perfect. But these are some of the things you need to do to have your house in order. Because as a parent, particularly, and I've got 4 young kids, I need to make sure that my wife and children will be looked after if something were to happen to me. And that's, to me, a biblical responsibility as a father, but also just a practical thing to make sure that they're not in any hardship if something were to happen to me. So here's what I want to encourage you to do, given what we're talking about today with coronavirus, etc., is how much cover do you need? So, and that's something I've got to unpack that a bit for you, but we've got limited time today to do that. But how much cover is appropriate for you and your family? Okay. What cover do you already currently have? Okay, and on that basis, if you don't have enough, what cover do you need to take out, or do you need to add to your existing cover? And then, of course, what can you afford? Because with insurance, there's often a balancing act between what's affordable and what is, a sensible amount of cover. And there sort of can be a tug of war there, depending on your personal circumstances. But they're the things you need to review. And of course, do you have the right, is it the right insurance company? Are there better policies? Or policies that represent the same benefits for a lower cost, and so forth. So there are things you want to review here just to make sure you're doing the right thing. So that's that one. Step 6 is just a passion of mine, is encouraging people to save. And I try and encourage people to save at least 10% of their income, okay? Most people are not great savers. You only have to look at the stats to see that. But I want to encourage you to try and save at least 10% of your income. Now, how do you actually do that? Well, we mentioned before, you do your budget and you work out where you can cut out any waste. We want to try and automate our finances. So try and save 10% of your salary and put it out off into an external account. We want to get rid of our credit card because that's a huge temptation to spend rather than to save. And it's just all practical things you can do, buy secondhand. When I bought my wife's car, we bought a secondhand car, it's a couple of years old and so forth. So there's all sorts of things you can do to save money where you get the same benefit, but you just don't waste it. And we want to try and save as much of our income as possible. In fact, there's a great saying, John Wesley, many of you would have heard of, the famous John Wesley, the old English theologian. He used to say, make all you can, save all you can, give all you can. And when he passed away, he had given away most of his money in his life because even though he'd done well and he'd made money, he saved it and he gave it away. And as believers, as I say, money should flow through us like a river. So we want to be able to save it, not to accumulate for no meaningful purpose, but we want to save it also so that we can use it and do good with it. And here's the power of saving. If you can afford, you do your budget and you can save $500 a month. This graph assumes that you start off with, I'll just give you assumptions here. If you start off with $10,000 and you save $500 a month, in 30 years, that will have grown to $460,000. Now, that's on the assumption of interest rates at 5%, which obviously is not there at the moment. However, that same concept could apply to other things like shares and real estate. So same logic, if you're applying this compounding process, you can grow your money to achieve that kind of result. Now, if you increase that to return to 10%, which is what you're likely to get, well, not quite 10%, but if you invest in the share market and things like that, the long-term return is about 9% pre-inflation. The real return after inflation is more like 6%. Likewise with property, you get a bit of capital gain, plus you get the rental income. But if we're getting these higher rates of return, that $10,000 plus adding to it every month can grow to nearly 1.4 million. So the key message here is you want to try and save 10% of your income and you want to start as young as you possibly can. The younger you start these things, the more you're setting yourself up for the future. And then the very last step, because I know we're running out of time and there's lots of questions. So the last thing is to try and automate your finances. I believe that God calls all of us to different things. She's called into vocational ministry as a pastor. Some of you are called to business. We're all called to different things. And my view is the focus of your time should be on the things that God is calling you to do, not on money. But we are still called to be responsible stewards of what God has given us. So what I encourage people to do is to automate their finances as much as possible so that they don't have to think about it all the time, okay? And this helps you get your money. This helps you to behave better with money, okay? If we're talking about getting your house in order here, if you want to behave better with money, you want to try and automate your finances as much as possible. And so we want to fund things like our emergency savings, our long-term savings, and our additional debt repayments. So if we come back to an earlier comment before, where we talked about doing the budget, if you've got a home loan and you think to yourself, well, I'm currently paying it off over a 25-year period, but I want to pay it off sooner. I want to pay it off in 15 years instead. Well, do your budget and work out what monthly amount extra do I need to repay? And there's all these brilliant online calculators. How much extra do I need to pay it off in 15 years rather than 25 years? And what you want to know is how much extra per month you need to pay. And by doing that, you can automate that process. Maybe you're paying currently $1,000 a fortnight and you can bump it up to $1,200 a fortnight, so you're paying off quicker. Likewise, with your long-term savings, you might say to yourself, okay, well, currently I can afford to save $500 a month, but I've just got a pay rise, so now I can afford to save $700 a month. Automate that process. You want to make it so that the day you get paid, the day after, your money gets swept out into a long-term savings account. So it's automated. It's happening without you having to think about it and before you get tempted to spend it. And same thing with your emergency money. So we want to try and automate our finances as much as possible so that it all kind of happens in the background without us having to think too much about it. So automate getting out of debt and automate our long-term saving. So there's some things for you to think about. So some action points from today. As I said, it's about getting your house in order. do a budget. If your circumstances are such that you earn income erratically because of your job, you might want to do what we call a cash flow analysis, where you look at it month by month rather than just looking at it as a 12-month type thing. Start your emergency fund, try and save 10% and give 10%. So there's some things just to get you started and get your house in order. We talked about insurance. Review your insurances and also review your debts. Make sure you don't have too much of it. And if you do have it, what can you do to pay it off quicker? Should you be refinancing and things like that to get your debt down as quick as you possibly can? So we're going to have Q&A.
Great. We'll go from top to bottom, I guess.
Okay. Just another comment to make. There's a lot of free resources on our website, purpose, free ebooks, our toolkit. We've got our budget planner in there. And I think, Chi, you're going to give out the Financial Freedom Express course. If you haven't.
Yeah, correct. So that's available on our website. You'll tick that and you'll go into a link. And a lot of what Alex has covered, some of it's actually in that course. I've actually walked through it, including the budget planner. Someone was asking about it. You'll find that as part of that as well. But yeah, that's available on our website.
Yeah, and that'll go into a lot more detail than what we can obviously cover off in today. Yeah. It's 34 modules of about 5 minutes each, so it's designed you can do it over time very easily.
Great.
Hey, Q&A, let's jump into it.
Young is the first one, probably ahead of your talk, but what are the best ways to improve incomes?
Yeah, there's probably two ways I can answer it. So there's income from your job and obviously working your way up in your profession and building your income there, or having a second job, that kind of thing. But there's also building your income from the point of view of investing. And what I encourage people to do, and this is a topic on investing, which is a big topic, is to create what I call create a growing income stream. And the best way to think about that is you want to buy investments where the income rises every year. So if I use property as an example, if you buy an investment property, you want to bump up the rent every year, okay? Because as the rent goes up, your income goes up every year. So you're creating a growing income stream. Likewise, if you buy shares, for example, you want to buy shares where the dividends are increasing every year. Often, a lot of people get confused with shares. They think of it as the volatility of the stock market as being their only source of return, but the real return in shares is actually in the dividends. In other words, the income that they give you. So you want to buy companies where the dividends are rising every year, and that way you can improve your income that way. So hopefully I've answered your question. So one is you grow your income through your salary and your job, and you get promoted, and or you build your business, that kind of income through your employment. But then there's building it through your investments. And shares in real estate are probably the best way to do that, where you're investing in investments where the income grows. Question here about, is it a good time to get your funds out from your super? I think I answered that one before. And so the answer is I discourage people from taking out your money out of super unless you really need it, i.e. you're in financial distress of some sort and you really need it. What do you think about using a buyer's advocate for purchasing investment property? Generally speaking, I'm a fan of it, simply because my experience is that people fall in love with property. So they see a property, they go, wow, it's beautiful, and they love the look of it, and they fall in love with it. And then all rational economics goes out the window. And so if you use a buyer's agent, if they're good and you want to get someone who's very experienced, been doing it for a while, they can they know the market backwards. They know if you're paying too much for something or too little. They know where the good spots are to buy. They know the better types of properties to buy, the better types of properties that can be developed. There's all sorts of benefits by using an expert, in my view. So I've met one or two buyer's agents over the years that have been very impressive in terms of good at buying that. Some people are what I call they're penny wise but pound foolish. That is, they don't want to spend much money. That they save it, scrimp and save, but they don't want to pay someone to give them good advice. And that applies to financial planning as much as it does to, say, a buyer's agent. Getting good advice, and same with accountants as well. Getting good advice can make a big difference and can help you avoid making mistakes. So
Yeah,
Sorry?
just for those, just in case we don't know what buyer's advocate is, could you explain that for those who may not?
So a buyer's advocate is someone who they can have multiple roles. So there's multiple things you can hire them for. But first part of the process is generally, they're often referred to as a buyer's agent, where they act on your behalf as the buyer. See, when you deal with a real estate agent, they are always acting on behalf of the seller. The seller is their customer, and they're trying to get the highest possible sale price for their seller. A buyer's agent is acting on behalf of you as the buyer, and they will research and source properties for you. So that's the first thing. They'll actually do research and try and find a suitable property for you based on your needs and based on your budget. That's the first step. The second step is that you can pay them extra and they will negotiate on your behalf. In other words, they will negotiate with the other agent, or they'll negotiate directly with the seller. And that can be very effective because that can remove, they can be more skilled at negotiating because it's something they do for a living, but also it can remove the emotion from it that you would have. That's why I'm quite a fan of buyer's agents and generally in favour of them. Yeah.
Great.
Anonymous question here. Could interest rates go negative? What would that look like? Sadly, the answer is yes, they could go negative. That's dependent on the Reserve Bank of Australia. They're already negative in some countries like Japan and Europe. What does it actually look like? What it means is literally your bank account, the bank would be deducting interest from your account. So rather than adding interest or having no interest, they would actually deduct it from your account. It has all sorts of negative flowbacks because what it does is people then put their money into other things such as gold. In the case of Sweden, where they have negative interest rates, what some people are doing is prepaying their taxes. So they're paying their taxes in advance so that the money is sitting in the tax office bank account, not their own. And then when they do their tax, they get the money back. So there's all sorts of crazy side effects from it. But yes, they could go negative, and that means you would literally get a negative rate of return on your bank account. Let's ask a question, is your super fund safer in cash as opposed to a default or balance fund? The short answer is, in the short term, always is yes. So to give you a bit of a picture here, as a financial planner, when we meet clients for the first time, we go through this process called risk profiling. And what we're trying to do here is determine how much money should be in defensive assets, so low risk assets, versus how much money should be in growth assets. Part of that is driven by someone's age. So the older they are, typically the lower risk we would take. Whereas someone who's, say, 25 has, 40 years before they're going to retire, so they can take lots of risk in their super fund. So in that sense, super funds are always safer in cash in the short term, right? But in the long term, cash is disastrous because the interest rates are so low and they never grow. So in the long run, you want the safest place to have your money in the long run is property and shares because they grow and therefore they keep up with inflation. So because inflation is what we call the silent killer, and that eats away at your money over time. So you want to invest your money to grow in the long term. But in the short term, as I say, cash is always the safest because if the stock market crashes like it did back in March, it fell 36% in just 3 weeks, which is a massive fall, then cash will always be safer in that sense. So I hope that answers that question. But it's what we call an asset allocation decision. And that is how much do you have in growth assets that are going to go up in value and are more volatile versus defensive assets that are safer in the short term, but are negative in the long run due to inflation. Do you think establishing short-term and long-term goals for savings are important? And if so, what considerations should we take into account in doing that? Also, what things should we take into account in monitoring our superannuation, particularly during this time? Okay, great question. So yes, with goals with clients, what we do is break up into short-term, medium-term, and long-term. And those savings goals obviously relate to different types of things. So the long-term goals typically are things like saving for retirement. And then short-term things could be, maybe you're saving to buy yourself a new car, or you're saving for your first home, etc. Medium-term goals might be things like you're saving for, like if you want to put your kids in private school, you're saving for their education. So that's short-term, medium-term, and long-term. They're the kinds of things you should save for. So do I think that's important? Absolutely. And in fact, often I suggest clients from a behavioural point of view, they set up bank accounts for those specific goals. Because what we're trying to do here is create good behaviors. Okay, it's not enough just to think about the goal. It's another thing to put in place the behaviors. So depending on the person, you may have specific accounts specifically for certain goals. Particularly as these days you can do fee-free banking. The second part of your question, what things should you be taking into account in monitoring your superannuation? Look, I think when times like this come, it's a great opportunity to reflect on how you're managing it. So a couple of things you want to look at. What are the fees you're paying? Are the fees fair and reasonable for what you're getting? What investment options you're in? Are they appropriate given how you feel about the world, what I call the sleep at night test? Are they appropriate for your age? Do you have insurances through your super fund? And that can be a good thing or it can be a negative. Maybe it's eating away at your super, or it could be a good thing if you've got circumstances where you need insurance, to protect your family. So all those things are important considerations at this time. In terms of superannuation, it's always important to remember it is a long-term investment. So things like stock market crashing and things like that, look, they happen every 7 to 10 years anyway. That's kind of just part of parcel of investing. So I don't get too concerned by that. It's more just about making sure you have a long-term focus to it. Where it becomes an issue is on your age. So where we're much more cautious with clients is as they get closer to retirement, we reduce the risk, because what you don't want is a big drawdown in the early years of retirement where their capital is negatively affected because of stock market crashes. And there's lots of ways you can construct the portfolio to minimize that damage anyway. So anyway, I hope that answers a lot of your question there.
Now, Alex, with that, in terms of long-term retirement, I mean, I'm turning 40, and oftentimes people think about retirement a little bit later, right? They go, I'm 40, I've got a household debt, mortgage, I just need to get through that, then I'll think about retirement. When, and especially when you talk about compounding, when's the right time for us to start thinking about retirement?
Yeah, look, I certainly wouldn't want to leave it any later than 40.
Yeah.
What typically happens, most people don't come and see me as a financial planner until they're about 55. That's probably the average. In fact, in the last week, all the people that have come and seen me have been 60. Okay, so they've left it until then to come and see a financial planner.
Yeah.
So 40 would be the latest. There's often different priorities based on our phase of life. So when you're 25, your priority may be to buy your first home. And when you're 40, your priority may be, paying school fees, paying off any left amount in the home, etc. So retirement becomes a little bit delayed. In saying that, you should still consider it, and it may well be appropriate to do certain things like salary sacrifice in the super and just bump it up a little bit, so that way you're preparing yourself for the future. To some extent, slightly difficult question to answer because individual circumstances dictate how we address that particular issue. People's incomes, etc., and tax liabilities and things that would affect how we do it. However, your point's still valid, and that is that I would say to people, you wouldn't want to go to 40 without thinking about it and dealing with it.
Yeah, yeah. So I'm just raising the common traps that oftentimes people fall into, where it's just too late and you don't leverage on it.
A question from around family trust structures in order to, among other things, distribute to charities so as to be more tax deductibility. So family trusts are a really common thing. I personally use a family trust. I tend not to give so much through it in the sense that you can get that same deduction personally anyway, in the sense that trusts don't pay any tax. It's the end beneficiary, so it doesn't necessarily have any benefit. Depends on, look, there's a whole range of factors. It depends on how much money is in the trust. It depends on, like, if you're an entrepreneur, a lot of people use it. So the reason why I use it is my financial planning business is owned by a trust, and then I can distribute the income to the trust. So it's actually more a tax issue than anything else. Family trust structures can also be beneficial though for asset protection reasons. So once again, if you're an occupation like mine where there's a high risk of being sued, then that kind of thing is also very useful as well, having that kind of family trust structure. So yeah, the answer is I'm generally in favour of them, but it comes down to circumstances. If someone's self-employed, then generally it's worth considering. If they're a high income earner, it's worth considering. But keep in mind, there is a lot of accounting fees potentially attached to them. because you can have a separate set of accounts done for a family trust. So it needs to be justified by either high income or high assets to really make it worthwhile. But generally speaking, I'm in favour of them, and I personally use one myself. So they do have benefits. Okay, so question here. Is there a simple way to project where you need to be at the point of retirement? I've heard what paying off your home loan isn't going to set you up for the latter part of your life. That's a fabulous question. It's probably the most common question I deal with as a financial planner. So in other words, when someone comes to see me, mostly they don't know how much they need to get their income in retirement. They don't know that. And so it's a big part of what we do. So what I would encourage you to do to think this question through is firstly, determine how much income you're likely to need in retirement. Now, the way to work that out is by doing a budget today and look at how you spend your money today. And then in retirement, there's a few assumptions you can make. So most people are debt-free in retirement. They've paid off their home and the kids are grown up. So they're two big expenses that have all of a sudden disappeared, and you'll need a certain amount to live off. And let's make up a figure. Let's say it's $60,000 you need to live off in retirement, right? We can then go and work out how much capital is needed in order to give me that $60,000 a year in retirement. Okay. And that will be dependent on a certain assumptions, such as what age you retire. Obviously, the later you retire, the less you'll need. And obviously, it depends on assumptions about investment returns as well, and taxes and so forth. But what the best thing to do is go onto an online calculator, probably just a simple one, just off the top of my head, AMP. If you go into Google and you type in AMP retirement calculator, what you can then do is type in what income you want in retirement, and it will help you and project how much you'll need. So you type in, let's say you're 45 today and you want 50 grand a year in retirement, you type those variables in and AMP calculator will spit out how much you need. Okay, so a really useful way of doing it. And that's a lot of what I do as a financial planner, is helping people work out what income they need, how much capital therefore they need, and how do we make it last as long as possible. So that's a very good question there. Thanks, Dutchy. Okay, yep, so the question here is, what are your thoughts on life insurance via superannuation versus private providers? It's a great question, Peter. Generally speaking, there's good reasons to have life insurance via super. First thing is it's usually 15% cheaper because life insurance premiums paid out of a super fund attract a 15% tax rebate. So effectively the premium ends up 15% cheaper by having it inside super. What we do for clients is we get a policy that's not linked to their super fund though. So the premium comes out of their super fund, but it's not linked to their super fund. In other words, we use a private provider, so a private insurance company, and we link it to their super fund. Now that has a few advantages. First thing is we can choose a better insurance policy than what their super fund may have to offer. That's the first thing, so we can choose a better policy. The second thing we can do is it means that the insurance policy is portable from one super fund to another. Because some of you here will probably have industry super funds, and therefore, if you have life insurance in that industry fund, if you move from one fund to another, you'll lose that cover. And you might not be insurable when you move to that next fund. Okay, that can be problematic. And you should never change super funds from one to another if you need that insurance, because you don't want to lose the cover. So we always get policies where we link it to super, but it's a portable policy in the sense it can be taken from one super fund to another. But you still get the 15% tax rebate. So that's how we generally recommend. Keep in mind that you're eating into your superannuation fund by paying insurance out of it, rather than paying it out of your own name and out of your own budget. Now, some people top up their super fund anyway to allow for that.
Alex, the top one, here, I think this is an important one to answer to help someone. Okay, so the question is, you mentioned on and off about the fact of immigration. In case I'm partially a part of it, due to the fact that I'm an asylum seeker waiting for my visa status to be resolved permanently, so I'd get a refugee status. Is there any institution, foundation, center that you know of people like myself would be provided a pathway to get some relief regarding expected costs? For your information, I'm on a bridging visa, which restricts me from working. No work rights granted yet. That's difficult.
Yeah, the people I talk to there would be the Salvation Army. They're brilliant with that kind of thing. If you've got debt, you might be going into debt because of what's going on. Is Christians Against Poverty would be worth having a chat to as well. Obviously, there's government agencies that will probably helping people at this time with that. But I must confess I don't have any specific expertise in that area, in that kind of refugee status and what options are available to you. So I apologise for that. But I would certainly talk to people like the Salvation Army and so forth, because they can help out a lot with people. So question here around superannuation, and is it okay to contribute extra amount to your super every month? The answer, there's a short answer to that is yes, but there's a lot more detail to that. Couple of comments. Firstly, superannuation, when you put your money into superannuation, you have to remember that it's locked in there until you reach what they call preservation age, which is age 60 for most people. Okay, so once your money is in super, it's locked in there. You can't get it out. That's the first thing. What's going on at the moment, where the government is allowing people to take money out, is a rare event due to obviously the rare nature of the pandemic. But keep in mind, if you put money into super, it's locked in there. Now, that's not necessarily a bad thing, because it is a long-term investment and it is taxed concessionally. So the average Aussie pays, generally speaking, at least 30 cents in the dollar in terms of tax, 30% as a general rule. Whereas in superannuation, it's taxed at 15%, okay? And therefore it's more tax effective for most of us to have it in there in retirement. Second thing is, when you retire, your superannuation tax rate drops to 0. It becomes a tax-free entity once you're fully retired. So super becomes very attractive. So the short answer to your question, is it worth putting extra money into super? The answer is yes. However, there are other circumstances that may affect you. For example, if you've got a mortgage, you want to prioritize your mortgage first, and if you've got other things to consider. But as an overall view, it is generally good to add extra into your super for retirement purposes, and it can be very tax effective to do so. So,
yeah. Great. Well, thank you, Alex, and thank you, everyone. Just reference for those that question regarding asylum seeker, there's an asylum seeker resource center, www.asrc.org.au, a possible resource for free financial, legal, health, casework, accommodation assistance. So asylum seeker resource center. So for that anonymous person, if you need that, perhaps that would be helpful. But otherwise, the last thing is also, we had a section on, as a church, we're running a estate planning session with our Embrace and Empower ministry, which is our men and women's ministry, on the 8th of August, 2 p.m. So if you want to get in on that detail, you can just sign up through our online to get our newsletters, or just watch our YouTube channel on Sundays, and we'll let you know those details, because I think, Alex, you alluded to that. We don't have time to do that. But that's with someone else. But it's just something that those ministries are doing. But otherwise, we have another webinar next week, which is making a kingdom impact. And Alex will be hosting that as well with me at 11:15. So register online. The free financial express freedom course is there as well. But a massive thank you, Alex. Yeah, and thank you, everyone else.
Thanks, guys. Great to be with you, and I'll see you all next week.
Great.
See you guys.